J.C. Parets. He's the founder of Eagle Bay Capital, a 10-year veteran in the markets, market technician. JC, well, let's first just go to the broad market here. And boy, oh boy, what a chop fest here in the 2110, 2120 handle. What is your technical take on the overall market?
Yeah, I mean it's been quite the chop fest. It goes back to the old saying: if you trade the averages, you generate average return. And I think what we've seen so far this year is a good example of that. But I got to tell you, underneath the surface, we've seen a lot of sector rotation where the leaders in the first quarter weren't necessarily the leaders in the second quarter. We've seen money rotating out of some sectors into others. Going into Q2, the energies and the materials and, the quote-unquote global growth names and emerging markets have been doing well. And now we're starting to see strength back into tech and financials, and even healthcare and biotech. So, I think underneath the surface, that's where the real story is that sector rotation. And if you're just looking at the averages, you're not seeing that and you're not making any money. So, that's why I think that looking at all those sectors and, seeing what's going on within the components of the averages themselves is so much more important than, what ES is doing.
Well, let's dive into some of these components. And just before you came on here, we're talking about Facebook here and how this has actually held up compared to Twitter and LinkedIn. Facebook has held up very well, and it got a nice pop there yesterday, actually popping over $2 if we're looking at it just from yesterday's trading action there. What are your thoughts on Facebook here, JC?
It's been in a nice consolidation. It's probably going higher. We really want to see it take out that 86 level. There's not really much not to like here. I'm with you guys. It looks great. I'm in the camp that we do take out that 86 level, which were the highs from March and April. Will we see some trouble there as we approach that level? Sure. We got to assume there's going to be some overhead supply there. It'll probably back off a little bit once we get there. But I think that retest of 86 for the third time is super bullish. I'm not, triple tops don't exist where I come from. So once we test that for the third time, I think ultimately we see a fourth, maybe even a fifth, and then we're off to the races, and we see $100.
What about, we were just talking Twitter here too, and Twitter actually caught a little bit of a bid finally there yesterday, but Evercore coming out and downgrading it this morning, so it's trading right back down 20 cents here. Do you think Twitter's eventually going to show some life here, or is this just dead money?
I told you guys over a month ago it was dead money.
But I know, but that's a month ago. We know you changed your opinion, Jason, so I got to get your opinion now.
Fair enough. Okay. Yeah, I mean, we probably do get a mean reversion. We're starting to see some bullish momentum divergences on these new lows. We got a pop yesterday. It kind of faded a little bit with the market. I don't own it. If I really felt that we were going to mean revert towards 44, I'd be in it. I totally would. And truthfully, this is probably a name that I could see myself owning, just because the risk is so well defined, and to me, that's more important. So you've got a dollar of risk, right? Because those are the lows from a few weeks ago. So you can own it above that. I don't think that's a terrible trade, actually. You can own it above that. You don't want to own it below 36, whatever that late May low was.
Yeah.
That's your stop. And you fade it towards 43, 44 as a mean revert. So as a trade from a risk reward standpoint, you're looking at a 7-to-1. That works for me. So if you're in it, I don't hate it. But I'm not in it.
They kind of got punished on their earnings kind of twice. Because the earnings came out, there was a leak
before the bell.
Yeah, before the bell, and they pounded it. It caught a lot of people, leaning, in the individual stock. Actually got halted, and then they actually came out with the news, so it kind of got punished from that. But once again, when you got a stock like this, there's a lot of people underwater, so if you are playing it from the long side, you do have a lot of company. Let's just move on here. We always like to talk, interest rates with you. We have the unemployment number. I mean, the Fed has made it very evident, and it's data dependent. I know what your stance is long term. Rates aren't going up here. But the TLTs is definitely painting a different picture here. Give us your take on the unemployment number, the Fed, and interest rates.
Yeah, I mean, you guys remember, we came into the second quarter, shorting bonds, thinking that interest rates were going to mean revert to the upside, within the context of an overall 35-year downtrend in rates. So again, we always like to put things in context. So, we came into April, looking to short bonds, and that worked out really well. But remember, our target was 2.2 on the 10-year, and we hit that. So it's been a no touch. I mean, we fooled around with it a little bit. We were long bonds. We sold them on Friday. I still like them. Quite frankly, I kind of wish I would have bought them back yesterday. I didn't. I think rates get slammed here. I think bonds rally. I'm not in that trade. I don't have a position, so I'm not talking my book. I'm just telling you, what I'm seeing. I think got a little ahead of itself. Everybody and their brother thinks that rates are going higher. I don't. I think rates get slammed, bonds go up.
JC, we always ask you individual stocks, and we always ask you your opinion on the markets. Let's talk your book a little bit. How many trades, like when you're doing trades and you're setting things up, do you have like a couple trades, a couple dozen trades? How many trades are you actively in at any given time?
A handful, no more than 5 or 6.
Okay, so you're watching 5 or 6, and you're moving that money around.
I'm in 5 or 6 names, and I like to treat my portfolio like a basketball team, right? Risk management is priority number one, and I don't like my trades to be correlated. We're long sugar, for example, which has absolutely nothing to do with whatever the government makes up tomorrow. So I like to be in things. We're long Canadian dollars, for example. That may or may not be affected. With what S&Ps are doing, but they're their own trades. So if you're a head coach and you're gonna take out a guard, are you gonna put in a center? That's going to change the dynamic of the basketball team. If you're going to take out a center, you put in another center. The correlations are going to be. The team is probably going to look somewhat similar than it did prior to that change. So that's kind of how I approach the portfolio. And whatever we're taking out or whatever we're putting in, the big question is how is that going to affect the overall correlations with the portfolio? Am I going to be overexposed in any one area by making that decision? And with that, then. We need to do certain things. We were in bonds until last Friday, obviously because we thought bonds were going to go up, but, it was mostly, as kind of like a hedge because we're long stock so much. So that's really how I look at a portfolio.
And you're hanging with your wheat trade here. I have the wheat ETF up. I see we had a little bit of a pullback down to the lows of the move, but right back up. Did they get you on that decline, JC, or are you hanging tough?
I'm not in it. We actually sold it a couple of weeks ago. When we had that huge move, it was a few Thursdays ago, we had such a huge position, and it was a 7% move, 10% overall. And in futures, that's so big, I had to take it. And, I really was considering buying the dip because it dipped back last week to right where we originally bought it the first time. We're actually a little bit higher, but I didn't get in it. We were already in the sugar. And I prefer to be in sugar than in wheat. So I'm in the sugar, but I do like the wheat. I think if we can take out 530 on the wheat futures, I think we're going to go a lot higher, probably around 650. That's a huge move. So in terms of wheat, that's what I'm waiting for. In the meantime, I'm in the sugar.
What are you looking at in the sugar chart here?
Same thing. It's the same trade. Bullish momentum divergence. Failed breakdown below the late March lows. Very, very bearish sentiment. Kind of like the JC, checks all boxes sort of trade. I think it mean reverts. Realistically, I'll probably be selling around 13.5. Here we are at 12.12. So from a risk reward standpoint, it just makes a ton of sense. The lows are very tight, very well defined risk. And a target that's exponentially more than the risk that we're taking. So, that's really all that matters to me, as you guys know.
Do you follow the commitment of traders at all, or let that be a factor at all?
Yeah, of course, absolutely. We want to see what the commercial hedgers are doing. We want to see, if they're buying. Right before that wheat trade, actually not right before, we were already in it. the commercial hedgers were loading the boat. They were buying, and we were already in. And the Friday before the big move up, the COT came out, and the commercial hedgers were buying even more. So, it really made me that much more bullish that the smart money was loading the boat, and we're fortunate to be on the right side of it with them. So, yeah, I look at that every week when that comes out. I find that to be really, really valuable. I mean, I don't know how people don't look at it. You look at sugar, and we're in a similar situation. A lot of pessimism out there. When it comes to sugar, seasonally, this is a good time of the year. So, when you factor in all of that together, it's hard not to be bullish, and particularly because the risk is so well defined. It's like I don't even care if I'm wrong. I mean, sure, would I prefer to be right and prefer to make money? Of course. But is it that big of a deal if I'm wrong? Not at all. So that's really the biggest deal. That's more important to me. In a case like Facebook is a much stronger chart than sugar. Much healthier in a bull trend. But the risk is very hard to define, and the amount of risk relative to the potential reward just doesn't suit my needs. So that's why I'm not long Facebook. Although Facebook looks much better than sugar. The risk is just so much better well defined. So I hope that makes sense.
It's all about that out and having that out. And that's what I always say. If you're disciplined and you've got those out and define those outs before you enter the trade, you can be in this game a long time. And that's the key. I completely agree with you there, JC. From the chat, we've got Rob Hood asking about UTX. He wants to know your thoughts on United Technologies here. And what are you thinking?
Yeah, I think a lot about this name. As you guys know, I take my Dow 30 components very seriously. The old saying, don't buy Papa Dow. And I look through I'm actually going to do it tomorrow. I look through all 30 Dow components on multiple time frames, daily and weekly, every single week. I take my notes, I annotate them, because if, it's only 30 stocks. And if there's more good ones than bad ones, it's hard for the market to go down and vice versa. So, yeah, United Technologies is something that's very important, very near and dear to my heart. I think it's very, very clear here. You only want to own this name above 120. Those were the highs, about 120, 60-ish, if you will. Those were the highs back last March, last April, and June. Those resistance last year that, then they corrected. Then we had that failed breakout in February above that level, and that quickly reversed. But notice how after that failed breakout, United Technologies, this was in March and February and March, United Technologies didn't get destroyed. It's sold off and has been consolidating in a very healthy way, in my opinion. I think that this definitely gets back above that, 120 and a half level, and we're off to the races. I really do think that, and we have some targets above 135. So that's where I think it's going, and I'm pretty confident that we do break out. I'm not going to buy it until it does, but I definitely think it happens soon.
JC, you mentioned a couple of times here, you mentioned failed breakdown on sugar. You just mentioned failed breakout there on UTX. Why do you mention, first of all, the failed breakdowns and the failed? I like them for my reasons. I'm just curious why, you like these setups when they have a failed breakdown or a failed breakout.
Right. So remember, we're not trading companies. We're trading stocks. And,
yep.
That's forgotten very easily. At the end of the day, it's all letters and math. That's all that matters. We're studying supply and demand. It's not United Technologies like, do they make airplanes or, whatever airplane parts. I mean, quite frankly, I don't care what they do. We're studying the supply and demand for the actual stock. We're analyzing what the buyers and the sellers are doing. And in the case of United Technologies, you had a breakout to new highs, right? So you have a lot of people or machines or whatever it is buying those new highs. And then what happens is after a couple of weeks, it breaks those levels and falls back below. So now you have all of these longs that are trapped up there. You have all of the prior shorts that got stopped out that are no longer short the position. So everybody up there is wrong by definition. So there's overhead supply there. That's very natural overhead supply. There are natural sellers there that, are essentially going to break even again, if you will. So the market has memory, and that's really, really important. It's not about the company's earnings. It's whether someone's willing to buy it at a higher price than you buy it. I mean, that's what it's about. And that's the only thing that matters. And, in this case, until the market proves that it can get above that level and hold above that level and absorb all of that overhead supply, it's trouble. And, I take opportunity costs very, very seriously. and it can get really, really expensive if you're not careful. That's why we talk about dead money all the time. Twitter, I thought was dead money, and sure enough, it has been. And it's not even so much that you've lost money in it. Let's say it was flat. It's the opportunity cost. What else could you have done with that money to make to bring profits to your portfolio? And I think this is a good example of something that looks great, something that I'm very confident that's going to break out and go a lot higher, but it's just not there yet. So the opportunity cost is too great for me, and I'd rather wait.
We've been on the line with J.C. Parets. He's the founder of Eagle Bay Capital. He's a 10-year veteran of the markets, a technician. It sticks to his rules and follows them very closely. J.C., a pleasure as always. Thanks for joining us. We'll talk to you again next Thursday.
Thanks again for having me, guys. Good luck up there today. Go get them.
Thanks, JC.